Hi, everyone. I am Matt Warner, and I lead the Schneider Downs Transportation and Logistics Industry Group. At Schneider Downs, we provide a comprehensive suite of services across tax, assurance, digital transformation, and advisory. Our team works closely with both mid-market and large enterprises in the T&L sector, helping those clients navigate today's fast-evolving landscape. Our short video is designed specifically for business operating in the transportation and logistics space. It's been a particularly active summer for our industry, most notably due to the sweeping legislative changes introduced by the One Big Beautiful Bill, passed by Congress and signed into law earlier this summer. This landmark legislation brings significant tax and operational implications for nearly every business in the U.S., and our sector is no exception. If you haven't already, we encourage you to check out our full-length webinar hosted by Schneider Downs Tax Advisor. That session offers a deep dive into the bill's broad provisions and is available on our research page. Today, we're going to take a step further, focusing specifically on how this legislation may uniquely affect companies in the T&L sector. We'll explore which provisions could impact your operations, financial planning, and strategic decision-making. I am joined by Dan Phillips, who will help provide some insights into this topic.
Let's get started talking about what could be the important impacts of the OB3 when we look at the industry, transportation, logistics, warehousing, and any related industries or related businesses. As with any business in the U.S., there's a variety of changes that came through with the new tax bill, and those are going to have significant impact on your tax, not only this year, but looking forward into the years into the future. And some of those provisions might be very impactful to your industry, and some of them may not be so much, some maybe not at all. So what we're going to do is touch on just a few of the things that we think are probably the biggest needle movers for those in the transportation logistics space. First is the depreciation changes. Those probably something that most people are watching closely. They try to understand what's happening with the bonus depreciation, and that does get a lot of press as well. What the Big Beautiful Bill did here is kind of reset the 100% bonus depreciation. The Tax Cuts and Jobs Act, if you recall back in 2017, there was a big spend involved with that bill, and there's revenue raisers built inside of it. And some of the things we'll be talking about today are on the revenue raiser side and were maybe fixed or eliminated with the current OB3. Bonus depreciation is one of those where in 2025, we were in the middle of a phase out that was ratcheting down from 100% to eventually 0% on the bonus depreciation. And now we're reset back to 100. And so there's a variety of options. We're not going to get into the minutia of all the specifics here, but just keep in mind that you may, with assets placed in service, they may be eligible for 100% bonus. They may be at 40. You can always elect out of bonus and opt for some other options as well. And so there's a lot of variables in here, especially when you look at things with long-term binding contracts and other provisions as well. So a lot of those discussions are beyond what we're going to get into today, but certainly this is one that we wanted to highlight for you to understand, especially if you're an asset-intensive business, that the bonus depreciation is back in a taxpayer-friendly way. In line with that, the 179 expensing, which allows smaller taxpayers, or maybe those that aren't as asset-intensive, to elect to expense assets in the first year. And so mechanics are a little different than the bonus depreciation, but similar effect of bottom line taxes when we talk about expensing property that you brought into the business in the current year. Usually personal property is what we're talking about on this front. And the provisions for 179, the expensing side went from $1 million to $2.5 million, with the phase out increase to $4 million. So if you're putting in less than $4 million of property or something just over, 179 could be a good option. Maybe there's a combination of 179 and bonus that you want to look at as you're analyzing your tax positions. We can talk about the tax planning and how these pieces kind of fit together just in a few minutes. The second point we wanted to point out was the interest limitation under 163J. So the Tax Cuts and Jobs Act, again, on the revenue raiser side, put in a mechanism not only to limit interest for highly leveraged companies, an interest limitation that's based on 30% of your adjusted taxable income. But then a few years into the act, the provision changed where that 30% limitation calculation, the definition of adjusted taxable income, no longer was based on a taxable EBITDA as it started, but became more of a taxable EBIT. So you were no longer able to add back your depreciation and amortization expense. Again, a significant change for companies that were asset intensive and potentially highly leveraged, really felt the pain from the inability to deduct all of their interest expense. Where perhaps at the beginning of the Tax Cuts and Jobs Act 2018-ish, they may have still been able to because they were adding back significant amounts of depreciation and amortization. And so this is something that's probably a decent needle mover when you're talking about tax projections and things, and something you need to keep an eye on. There's also considerations for the carryover of any interest expense that you have from prior years. Depending on your type of tax structure, you're going to want to incorporate that into your current projections as well. And then the third piece we wanted to talk about was the research and experimentation expenditures. Typically, everybody refers to those as R&D costs under 174. The Tax Cuts and Jobs Act, again, as a revenue raiser, had baked in, and a couple of years ago, those costs were required to be capitalized. And so when we look at the impact that had on companies' bottom line from a taxability perspective, no longer expensing those costs in year one was a big burden and certainly a revenue raiser. There were several bills proposed over the last few years to try to eliminate that add back or to try to lessen that burden, but nothing really got passed until this past summer as part of the OB3. So what happened there? We were kind of reverting back to the old days, if you will. We're back to expensing, especially of qualified costs on the domestic side, expensing those costs year one. And there's also special provisions for any unamortized costs that you've capitalized in the past. So that's something you need to keep an eye on. Again, we're not going to go into all the mechanics and all the options, but certainly something you need to think about as you go through your current year analysis. And then, when we talk about what could happen or what changes are out there, one of the things when I talk about the OB3 is what didn't get in. So there was some chatter about certain things that could happen or maybe wouldn't happen, or maybe different versions in the House bill from what got through the Senate at the end of the day. And one of those is related to the SALT issues with the state and local income tax, deductibility of such things. There's SALT cap workarounds that you've heard about probably. Again, I'm not going to get into all the minutiae here, but to avoid the $10,000 limitation at the individual level, certain states customized workaround plans for pass-through entities. And so there was talk in some of the early negotiations and some of the early bills about eliminating this for the pass-through entities. There was also contemplation of denying state income tax deductions for federal C corps. And so, those things were on the radar and even in some early versions, but they did not make it into the current bill. So that's good news. Also, good news is that there was no additional higher income tax brackets. There's work being considered in the early days, and nothing made it in there as far as an additional 39.6 or 40% rate. We're back to basically the rates that were in play with the Tax Cuts and Jobs Act, basically being extended for all intents and purposes. So when you look at planning, the rates are going to be fairly consistent over time. One other question that comes up is, well, what about the changes in the credits and incentives and things like that are out there? There was a lot of changes and certainly a lot of credits that were eliminated from the Inflation Reduction Act. And, we could spend days talking about all of those changes specifically, but I think it's important to know that could be a direct impact to companies in this industry, or maybe even indirect. So you may have been benefiting from some credits directly, but you may also have customers that were potentially hauling equipment for companies that were involved in some industry that was getting credits. You need to take that into consideration when you're looking into your business now and what the impact might be. And so the last question I want to talk about is, okay, now we talked about a few of the big needle movers. what do you do now? Well, most importantly, you want to look mid-year at tax projections, look at your book income, look at some of these bigger items that are going to change for you. How much equipment did you put in service? The depreciation alternatives that you have there. What are the different levers that you can pull, and how much does it really change your taxable income? Same issues with some of the interest expense deductibility and the R&D costs that you may have penned up costs there that you capitalized over the last couple of years from certain technology development or software customization that you've done, and make sure that you're trying to capture those costs in the current year or whichever year you can, so that you're looking at it real time. If you're able to knock down the 2025 income, you may be able to look at the estimates that are coming up here in September and towards the end of the year to potentially save yourself some real cash, real time. And so it's important that we're all taking a good look at that and doing the analysis, understanding where you are at this point in time, but then also with a plan to revisit later in the year, potentially November-ish as you get closer to year end, to really see how you're tracking against that projection and understanding how that goes. So hopefully that helps you keep an eye on the important pieces here, or maybe the biggest pieces that you need to worry about. And I'll turn it back to Matt for some final thoughts.
This presentation is intended short dialogue to start a conversation. We work with numerous businesses in the transportation and logistics field, and we recognize that many of you have questions about how the significant legislation may impact your personal operations this year and beyond. We hope our insights were helpful in guiding you to better understand the opportunities and considerations for your business. Schneider Downs has a deeply experienced team of experts in the transportation and logistics space, and we are here to help. We invite you to visit our website's resource page for even more insightful resources. Of course, I'd also like to invite you each to reach out to us directly if you'd like to talk further about this legislation or any other topic related to your industry and our services. We do our best work in person, and I invite you to contact myself or Dan at your convenience. Thank you again for your time, and we look forward to hearing from you.